Hey everybody, Colin Plume, CEO of Noble Gold Investments, my digital Noble Gold, #1 gold IRA company in the country for the last 5 years. And we got Jake Bell, Senior Sales Associate, on the line, and we're going to get into a number of different things. We are going to talk later with Micah about the silver copper ratio, but we found this lady online that we think is pretty, this is the internet in its perfect form, right? Just regular person, camera, creates a video and breaks down some pretty complicated financial instruments and ideas in a way that I think anybody can understand. Is that
yes
on this, Jake?
It was she needs to hire an editor, right? Her clips are a little choppy, but that's okay. Her substance was there, and I think she was spot on. And what I'm going to talk about overarches with the Dodd-Frank Act, which was designed to prevent everything that she discussed. So I don't know. Are we going to roll that video?
Let's roll it. Yeah, let's dive right in. Let's get into it.
Last night, I started off by researching Hooters getting bankrupted by private equity and ended up uncovering the next 2008 level economic collapse. And they're hiding the bubble inside a private equity black box that makes it almost impossible to see what they're doing. Almost. This time, they're not going to collapse the banks and make it too big to fail. They're going to bankrupt the entire American pension system. I'm almost too afraid to make this video, but it has to be done, so let's get into it. In 2008, investors and bankers were able to crash the world's economy by engaging in risky, unethical bets and investments, and they did it right out in the open. They've learned, and this time they're doing it again. Bigger investments, bigger risks, same playbook, but they're doing it behind the smokescreen of private equity in bigger numbers. They're creating a bigger bubble than before, and it's not somewhere down the road. It's here, and it's about to pop. You see, for the last month, I've been trying to figure out why these companies that private equity had acquired were failing even though they were still succeeding. Joann's, 97% of their stores are still profitable, and yet they're still bankrupt. But they weren't bankrupt a year ago, and they still had the debt that private equity had stacked on them a year ago. So I wanted to know what changed. The same thing with Hooters. The same thing with... Now in 2024, private equity bankrupted 110 businesses. And that was almost double their previous record. There had been huge increases in the amount of bankruptcies each year over the past 3 years. But I didn't know what had changed because private equity had held many of these businesses for several years and they were still succeeding. Until I got my hands on an economic report and an article and found a term that nobody could explain to me. The term was back floating rate loans. I didn't know what that meant, and no article would explain it to me. So I had to go and do research in the financial prospectuses of a bunch of financial investment firms. Guys, in the last few years, private equity has taken out $3.8 trillion in adjustable rate loans. These are adjustable rate loans. These private equity firms took out adjustable rate loans. And so for the last 3 years, as our interest rates have gone up, every 30 to 60 days, the money due on the loans they stacked on top of these companies has gone up every 30 to 60 days. That's why these successful companies that private equity had acquired are suddenly bankrupt, even though they're still making money. They're bankrupt because they're paying adjustable rate loans. But it doesn't stop there. It gets so much worse because my next question is, why are the banks willing to give these risky loans to these private equity firms knowing it's going to cause them to fail?
Let's dive in
because
here.
The banks aren't going to keep them.
Yeah, let's dive in here on this topic. I'll just say from my experience, what she's talking about also happened and is happening in commercial real estate. It's been happening for a long time. When I started in commercial real estate, selling apartment buildings and shopping centers in the early 2000s, there was buildings that would sell with, based on current fundamentals, they would make 1 or 2% cash on cash returns. And so the banks realized, like, well, you can't go lower than that. What are we going to do? So what they do is they would do a few years of interest only loans. So there'd be no principal pay down on these commercial debt. Very similar idea is that basically the banks make a ton of money on this debt, fees, private equity. What they're trying to do is private equity gets money from investors, high net worth accredited investors. So they go into a company like Joann's. probably doing pretty well. And they go, well, how do we make it more as well? We'll sell off a few things. We'll do a few things here. We'll put some debt on. We'll pull some money out. And this is sort of a trickle effect that basically they just pull the money out quick to pay people, and then the business loses value. They've done it in commercial real estate. They're doing it all the time. They've been doing it for years in commercial real estate. It's the IO trick, the interest only trick, right? They can't pay down the principal. So the bank goes, okay, we'll let you have some breathing room for a few years. And so they create these instruments that are unusual instruments because either they want to take money out quick or the deal doesn't make sense. It just fundamentally doesn't make sense.
And these will always work until they don't.
Until they won't. Exactly.
And when you have a robust and resilient economy, these things can be swept under the rug. They don't go noticed. And when you don't, which I've made the case, and I think we agree that we do not have a robust economy. It's been stretched out over the last 4 years. Something small like piling credit card debt, savings being dried up,
right,
delinquency rates going up. All of these things are adding up and snowballing. And I did not enjoy that video. I watched it 3 times last night just to make sure it made sense to me. And of course it's happening. And again, what I want to talk about is the Dodd-Frank Act of 2010, signed in by Obama. It was in response to 2007, 2008 financial crisis. And it was designed to prevent 3 basic things: risky lending practices, specifically opaque derivative trading, right? Lack of oversight, and the interconnectedness of large financial institutions. If we brought an alien down from outer space who has no idea, and we asked them to analyze these 3 aspects of our economy, all 3 of those boxes are being checked off. And she detailed it beautifully. There's some more depth, go check out her post and scroll down. It's a thread. She gets into it, and it's good stuff.
Yeah. We got a question here from someone on is, what is an adjustable rate loan? An adjustable rate loan is basically the loan has a certain number of years that the rate will be fixed, and then the rate will go to a market rate. So for instance, if you're smart, a few years ago on your home, you could get a loan at 3% for 30 years. But some people were greedy and they said, well, the banks will give me 2% for 5 years, but then it goes to an adjustable rate loan. And the banks sold a lot of these, right? They sold a lot of these because people, in my opinion, were greedy. And now those rates are coming due. They're going to come due. Some people on their home have adjustable rates when they should have just pulled 30-year financing. So that rate, Rebecca, is going to go to the market. Now, the market from 2 to 3 years ago was 3%. And now, depending on what asset, a home or a commercial property, whatever, it could be anywhere from the high 5s to 7%. So more than double typically. And that's why we're sort of in this big bubble. And that's sort of what she dives into. So let's pop back into the video and she kind of gets into this a little bit more.
Them on their books. The banks are immediately repackaging these adjustable rate loans as something called CLOs, right? Which are then packaged and sold off to our pension funds as really great debt. And they tell them that it's a diversified portfolio. Are you hearing the Big Short in real time? Literally, all of these companies are getting bankrupted in greater and greater numbers. And all of this debt is adjustable rate. And all of the bankruptcies are skyrocketing in this direction. And now, if you look at this graph, you can see that aside from 2020, which is obviously an anomaly, right now, private equity, that's the yellow section, has double the highest number of bankruptcies they'd ever had prior to last year. And that number is climbing this year, $3.8 trillion. $3.8 trillion in this debt, okay? I want you to look back to 2008. Do you want to know how many risky adjustable rate mortgages there were? $1.1 trillion. Do you want to know how many subprime but not quite as bad loans there were? $1.3 trillion. That was just in housing. In the $3.8 trillion held by private equity, they own the largest shares of the home ownership market in the United States, but they also own the daycares.
Mhm.
They own the veterinary clinics. They own the pet stores. They own the nursing homes. They own the emergency rooms. They own the doctor's offices, the orthodontists. They own the builders. They own the HVAC companies. This isn't just housing. It's going to touch every single industry around us. And that is why, if this were a free market and private equity had not exploitatively gotten involved, if we had a free market and we could see what they were doing, these companies would be succeeding. If this were actually a free market, these companies would be succeeding. Joann's has 97% of their stores profitable. That is an astronomical number. 97% of a retail store is profitable, and they are failing and they are closing every store, and it is further consolidating an already consolidated environment. And now there are thousands and thousands of employees that will not have jobs. And there are thousands of other businesses that are going through the exact same thing right now. And why? Because they know we will never allow the banks to be bailed out again. We would literally riot in the streets. But we're definitely going to allow them to bail out the pensions, because that's our grandparents. That's our parents. That's the working class. They know that this will get bailed out. And because there's no regulatory authority, there are no laws stopping private equity from doing whatever they want, they know they can get away with it. And we can't do anything to stop them.
Let's pause it there for a second and kind of dive in. Just kind of go over what's happening. So she talks about 2008 because we have the CDO market. Everybody remembers, if you saw The Big Short, basically the banks were packaging loans. So they said all the loans were A credit loans, but basically they were packaging loans on homes. And a lot of the homes were in areas that people couldn't afford those homes. And so they repackaged the banks and sold them to another party. And there was, she said, 1.6 or $1.7 trillion in those. And everybody remembers what happened in 2008, that we had this big credit collapse. And, a big part of that was the way that they were doing loans back then, right? They allowed people to get loans with no credit. They called them ninja loans, right? They allowed them to just apply, and people that didn't have the income could buy 2-3 homes, because the banks didn't care, because they repackaged the debt, they sold it as a derivative to somebody else, and we saw that big collapse, and it was terrible. And people, lost homes and lost money, and nobody went to jail, right? Of course, there's, but the interesting thing about that collapse and this collapse, at least the banks got homes, right? When the banks got bailed out and the government came in and gave them money to buy these homes and keep these homes, there was assets. There was actually assets that went up over time, and the banks did very well through this transaction. This time, the problem is that the banks are getting corporations that are not going to have enough assets or debt or money to sustain. And so they're not getting assets that are as desirable as what they got in 2008. So what are the banks going to do with Joann's? What are they going to do with all these hundreds of companies that private equity has bankrupted? So this is the problem with this CLO collapse and this private equity collapse. That's another 2008 here. Yeah, yes, but in a way, it's actually worse than 2008, because people are going to lose jobs. A lot of these private equity companies buy heavy employer type companies. So people are going to lose jobs, and those jobs are not going to come back. And a lot of times these corporations, and I will say that she says something about the free market and how it's not a free market. The people that own Joann's did not have to sell to private equity. So I will say I disagree with that point. I think that a lot of times ownership of a company says, oh, you'll offer us this 10 multiple of what our earnings are, 10 years of net earnings. I can get it all right now. Great. Like, I'm out. I'm selling, right? But when they do that, they obviously substantially profit, but they put this company in jeopardy. So to say that people don't know what they're doing, the owners of Joann's, the owners of these corporations, they're getting paid a multiple of net earnings that they could never make in a quick amount of time. So they want to make it faster. And this is the whole problem. So that private equity comes in and goes, okay, we're going to shift management around. We'll cut some expenses, but how do we get the most amount of money out? We put debt that's cheaper and we pull money out. And now, as she talks about, there's all these companies that are coming due. What are your thoughts?
All of
Jake?
all of this is scaling. The thing that scares me is the amount of money. I mean, we saw what happened in 2008, and this is just
Correct.
exponentially higher. And so it just keeps getting kicked down the road. And again,
Right.
we're living in a world that needs to detox from debt. Good whack there, boss. We are over leveraged as a country and a world. And so again, when we talk about protecting yourself, you get something that's tangible. You get something that has no debt behind it. You get something that has zero counterparty risk. And of course, we're talking about precious metals. So
Correct.
Going back to how did we get here? Because we're not supposed to be here. That's why laws were put in place. Well, I feel like the matter. This must be what Lewis Carroll was observing in his time when he wrote Alice in Wonderland, because it's just the rules put in place have created more bureaucracy, and of course we've talked about Doge and all that good stuff, and that just cogs things down and does cog down the free market to some extent. It can't not do that, but the bureaucracy isn't moving. It cannot move fast enough to keep up with the nefarious players. You can all that's happened, instead of CDOs, we're using CLOs. The paradigm has just been slightly shifted, and the rules, the laws implemented have to be extremely specific. And again, nefarious players just shift. They just pivot ever so slightly. They're using the same mechanisms. We're seeing the same things play out, and it's scary as hell. And it sucks. And it sucks for people who are retired most, right? I mean, if you're on a fixed income and you're expecting your annuity to do things for you, if you're expecting the stock market to hold, it is not, you are not sitting in a comfortable seat at this point. You're on the hot seat.
Yeah. And the private equity moved away a lot of the risks out of themselves, right? They've transferred that risk to the pensions. Let's dive back in. Let's see the rest of it, see what she has to say here. She's frozen.
This was done.
Here we go.
The thing you need to understand is this wasn't done by accident. This was done by blatant, intentional greed. The private equity firms wanted the cheapest debt they could get, and they believed arrogantly that the debt would stay cheap forever.
Correct.
They had 0% interest rate loans for ages. And so they took on these adjustable rate notes thinking they could keep refinancing forever out of it. It was arrogant. But it also meant that they got to collect bigger fees because they were taking risky debt that cost less. The bankers were happy to give them because they got higher fees on offering bad debt.
Sure.
They were going to get paid no matter what. At the same time, the private equity firms mandated in their contracts with these companies they acquired that they were advisors and that they were a management company. So they also get paid that way. And then they sold the land out from under these companies and all their assets and made themselves whole before any of this even began. They're already cash positive. The banks knew they wouldn't be held accountable because they were going to bundle it up and pass it off to the pensions. And even the pensions were reckless because they're buying these mechanisms, because when you purchase into private equity, when you purchase private equity debt as a pension, you get to put on your books, especially if you have an underfunded pension, the projected gains for 10 years, which means for 10 years, it looks like that pension is more shored up than it is. And at the end of that 10 years, when it's time for that fund to close out, suddenly then all of the bad debt comes crashing down on the pension. But at that point, there's a new leader on the pension fund and they've kicked the can down the road. So even they were reckless. But at the bottom of all of this is the bankrupting of the fabric of our society. We are losing our businesses. We are losing our doctors. We are losing our orthodontists. We are losing our nursing homes. We are losing our funeral homes. And one by one, they're going to fall under the weight of this really horrible adjustable rate debt. And nobody is talking about it. I could only find 2 articles in very obscure financial magazines that even talk about these back floating rate loans. I have never been more terrified. And I talk about private equity a lot. I have a lot to say. But right now, all I want to do is get someone to pay attention that can make a difference in this, because we have a problem. We're not without any hope at all. Right now, private equity is only allowed to be this exploitative because they exist under something called the carried interest loophole, something that multiple Congresses have tried to close, but private equity continues to bribe politicians to fail to actually achieve. Trump, 3 weeks ago, said he wanted to close the carried interest loophole. I thought he was doing it as a fundraising maneuver. But he's doubled down on it repeatedly. If we can make enough noise about this, maybe we can get him to actually see it through and end private equity's stranglehold on our population.
So we got a question coming in. How can we stop this? And she gave one answer. The other answer is to take individual responsibility. If you're relying on the system to provide for you, then you're in the hot seat. You're going to wake up one morning. It's going to be a very ugly morning. So how do you make yourself your own financial sovereign? And that's a phrase that I use every day now because it's true. How do you detach yourself from a system? What puts you above the system? Well, the world's oldest, safest guarantee of wealth does, and that's precious metals. And of course, that's why we're here.
Yeah, absolutely. And I think the big loser in this, when you look at this, is the same as in 2008, the American middle class. Because in this situation, they're going to lose. They're losing jobs because there's, these corporations that are employers are shutting down. So they're going to lose good earning jobs. Their pensions are going to be in trouble. I mean, look at these companies, Red Lobster, Party City. Red Lobster, I know in detail, Red Lobster owned 95% of its real estate when private equity came in. And what they did was they went ahead and said, oh, we have all this good real estate. Why don't we sell it, put loans, sell the real estate to investors, and we'll pay rent. And instead of them just keeping this real estate, which kept their bottom line really low, they ended up selling it to investors. Because I looked at some of these Red Lobsters as an investment, and I said to myself, well, Red Lobster owns this outright. Why would they want to sell it? And it makes sense because private equity saw a big exit strategy for them. And it was just a way to get rich quicker instead of just slowly keeping that business going. Red Lobster's been around for a long time. Good name, good reputation. A lot of people love it. People were up in arms. True Value, Tupperware. I mean, look at all these companies. These are, big lots, consistently strong companies that have been saddled with private equity debt. And, these are the get rich quick sort of scenarios that private equity goes ahead and puts on, and they're putting these 0% loans on. And it's good for a minute, but then it really hurts, long term. So
this is our domestic version of globalization. It is getting away from the localization of power and ownership, which makes our economy robust. And again, this has been happening for years, and it's not like this came out of the blue. So, I'm sure we're closing up on probably going to commercial soon. So I wanted to get this in because it ties in. And again, we deal in gold, we deal in silver. Yeah. China bought more gold, surprisingly, bought another 160,000 ounces. That's 11 million in 2.5 years. They're at new record highs, nearly 74 million in fine troy ounces in their holdings. Central banks are buying as if there's a crisis already. And again, these private hedge companies, they've already pivoted. They're not going to be the ones holding the bucket, right? And so all this smart money is positioning themselves accordingly because there's a bubble. How do we avoid it? I don't know if we can. I don't think we can. I think it's going to get real ugly real soon. So again, what do you do about it? You get yourself something tangible. You get yourself something that detaches you from any one economic system.
100%. Jake Bell, thank you. Anyone looking to talk to somebody about gold and silver, give Jake a call. Great guy, one of our top guys over at Noble, and he'll give you the lowdown. And if you just looking to get some free information, or it's your beginning your journey, give Jake a call. He'll help you out. Jake, as always, thank you. We'll see you on the next one. We'll see you next week.
I got $9,000 of free silver when I bought gold.
$9,000 in free silver. What about the fees?
Well, there were some fees.
Management, commission, probably. Let me ask you, did you pay more than this for the gold?
I paid way more than that. That free silver wasn't free.
At Noble Gold Investments, we really focus on transparency, honesty, and no gimmicks.
I wish I had talked to you first.
Invest with confidence. Invest with Noble Gold. Micah, what's up, buddy? How are you?
Really well. Yourself?
Feeling good. Back from vacation.
Yeah, a little March break action with the kids. Always fun. I know you've got some coming up too. So
Yeah. I don't know if it's a vacation when you go with your kids, but
Yeah, it's kind of like sharing the burden of having the kids out of school.
It's just constant for the week or two that you're on vacation. But
You got to take some time.
It's always fun.
Super enjoyable, and the young years go fast, as you know. So
Yeah. Well, good to have you on. I know there's a lot happening out there, and we're going to get into silver, copper, all kinds of stuff. So
yeah, so I wanted to kind of go in a little bit of a different direction today and talking about why silver investors really need to be paying attention to copper right now. But it all ties in super well. And if anything, Colin, it makes me very, very bullish as to where silver is going as well. So we'll get into that. Something to talk about are the correlations between assets. You've heard me talk about ratio charts, gold versus the S&P, gold versus the NASDAQ. But it's important to know that gold and silver have obviously a very strong relationship. The correlation, the closer it is to one, the more perfectly they move together, whether up or down. Now, you rarely have a 1.0 correlation between any assets, but it's a very insightful piece of information to know what types of assets are trading closely. And so gold and silver obviously have a very strong correlation. Over the past 5 years, they have a 0.771 correlation. And over the last year, it's a 0.917. But the correlation between copper and silver is strikingly close as well. And it's something that I think kind of tells us what's about to happen in silver, because it's something big is happening right now in copper. So they've got over the past 5 years, a 0.725, just below the correlation between gold and silver. But in the last year, you've got between copper and silver, a 0.878 correlation. And so I think it's a compelling reason for us to talk about copper today, and then for our investment team to keep an eye on it and copper price movement moving forward. Yeah.
What when you say those numbers, go back for a second. What are you saying? 0.771. Kind of explain that a little.
Oh yeah, for sure. So if something has a 1.0 correlation, it means that absolutely no questions asked, bar none. If gold moves up, silver moves up with it. Okay. You and I both know there are some days when gold is up and silver's down, or silver's up and gold is down. And so they don't have a perfect correlation.
Got it.
But they do have a fairly strong correlation where they, for the most part, trade in tandem. So you could look at it as saying like 91% of the time, gold and silver are moving together. But 87%, almost 88% of the time, copper and silver are moving together as well.
So typically it's 72% for copper and silver over the past 5 years.
Yep.
But in the last year, 87% of the time, copper moves, silver moves.
They're moving together in the same direction, whether up or down. Exactly. And sorry for kind of glossing over that, but it's a very helpful way of breaking it down. And so let's talk a little bit about copper and silver here, in terms of supply, in terms of demand. So silver, as you know, Colin, from your book, and I think it's a really important thing for us to be able to talk about that too, because you touch on some of this information in your book, is most of the silver that's mined every year is actually a byproduct of base metal mining or gold mining. So 70% of all the silver that comes out of the ground is from mining companies that are pulling out copper, nickel, zinc, lead, and gold. Silver is a byproduct. There are very few pure silver mines out there. Mm-hmm. And so from a supply standpoint, that's how we get most of our silver into the market. But from a demand standpoint, copper and silver both have really heavy industrial uses. So they're very critical when it comes to electrification, bringing on new electrical grids, batteries, electric vehicles, clean tech, renewable energy. And so rising industrial uses for silver, which you note in your book, we're looking out the next 10 or 20 years, there's going to be more and more industrial demand for silver. The same thing's going on with copper right now, bringing on electricity grids in emerging markets or the third world is like just one example of a massive use for copper moving forward. And so the outlook from an industrial perspective for both copper and silver is very, very bullish. Okay. Now, when we look at the overall picture of what silver is used in or what the sources of demand are, this kind of breaks it down. So over 50% of silver's mining supply goes towards industrial applications. So solar panels, batteries, electronics, you name it, wind power, solar power. Jewelry is the next largest component of the demand structure for silver at over 21%. 18% alone of all the silver that's mined every year goes towards the production of the bullion items that we sell, silver coins and silver bars. And then you've got some smaller uses like silverware and photography is very. And so this is sort of the big picture of all the things that silver is going into. But that industrial application piece, which is now over half, is actually expected to go up by as much as 40% over the next 10 years because of all the electrification, focus on green energy and renewables. And so that's going to chew into other silver that's available for investment purposes, for example, like bullion.
What do you think will happen to the coins and bars, the percentage? Do you think we'll stay at that 18%, or what do you think at that?
I think there's going to be less and less available as time goes on. I don't see an immediate kind of inventory shock or supply shock to the availability of bullion in the next year or two. But we're in a huge supply deficit, as you know. We're not mining enough silver every year to meet all of the demand right now. I think we're on the third or fourth year in a row where we have a 200 to 300 million ounce deficit. And so that's chewing up a lot of other kind of above ground available stock. I don't know how much of that we've got left. And there will be a point in time when I think silver scarcity is reflected in the price, and we're going to get to that. But I don't see there being more of a share in silver supply for coins and bars moving forward. I think it'll become just more and more scarce, unfortunately.
Yeah, and what I'm hearing on the mint side is that more of the major mints are slowing down production. I know the Royal Canadian Mint's slowing down. I know the Royal Mint in the UK is slowing down. The US mints, it's hard to tell what they're going to do, but from what I'm hearing is that the mints are going to slow down production. So.
Yeah. Yep. And I think that'll be kind of a growing trend, and it'll make the coins that we have, in our clients' portfolios and in their possession more valuable over time. This next piece just gives you kind of a comparable for gold in terms of its overall uses. So when you look at the biggest chunk, 46% of all gold mined every year goes into jewelry. The next biggest category is central banking or banking uses, using it as a monetary metal. That's 23%. Only 16% makes its way into bullion bars. And then you've got 9% for coins and those types of things, coins and metals. And then you've got a very small chunk that's going into other or electronics category. So let's move on from this. Now, because copper and silver are industrial metals, silver has the benefit of also being considered money, and it has a history of being considered hard currency. So it's kind of a hybrid where silver is both a monetary metal and an industrial metal. But as we saw from the previous chart, over half of all the silver supply goes into industrial purposes. So because of that, copper and silver can be kind of like canaries in the coal mine in terms of economic cycles and where we're at in one. So they're very, very sensitive to economic data and projections in terms of the growth and strength of the economy. Now, for instance, when like a recession may be upon us, both copper and silver prices tend to decline. But conversely, if we're in a stronger commodity cycle or in an upswing economically, and we know that there's a lot of building that's going on and bringing on grids and development all over the world, then they tend to swing up. But gold doesn't have that same sensitivity to economic growth or economic cycles. It's more of that kind of safe haven. It's purely a monetary metal. It doesn't really have enough economic uses so that when the economic outlook looks bad, it kind of declines on that news. If anything, it goes up because it is a safe haven asset. And that's clearly what's been going on. So this next slide here.
Before we get into the next slide, I know we had a question
Yeah.
from the audience about buying gold, liquidating gold. So I just want to get in here.
Yeah, I'm happy to take a crack at that. I can see the question.
Yeah.
So what I tell all of our clients is it's just a call away, right? From the time that you come in, we help you with all your questions. We help you set up your retirement accounts. We'll help you choose the metals that you would like to own in your physical precious metals IRA. Those metals are then sitting in your own segregated vaulted account. And to liquidate those and actually get them sold back to us and get back to cash is just a matter of letting me know what it is you want to sell. So we don't have a transaction fee for the buyback that's unique to Noble Gold. And we have a fairly quick processing time as well in order to do that. So you want to think ahead. If you need money yesterday, you don't want to be calling me today because there's a bit of a processing time in retrieving that metal from your vaulted account and then depositing those funds into your IRA. But generally speaking, it's painless. We're extremely competitive on what we offer. There's no charge for that. And you just give your sales associate a call.
And this client wants to just not do an IRA. So they want to do a direct cash investment. So,
and then have it stored or with them at their home.
Yeah, it sounds like they want to have it stored at home. So they just want to know how easy it is to liquidate. And I will say this question's coming up a lot because obviously Costco's been selling gold and people have been talking to us about it.
Mm-hmm.
And, we're obviously very competitive price-wise with Costco, but the biggest thing is Costco is not going to buy back your gold, right? A lot of places are not going to buy back your gold. We are going to buy back anything that you bought from us. We
no
may
questions
buy back
asked.
stuff from you bought from Costco too, depending on the market. But anything you bought from us, we're going to buy back.
Yep.
It's an easy process. You just call our buyback team and get the metals back to us, and we wire you the funds the next day. So
exactly. So the only difference between the IRA and home delivery purchase is we'll arrange the shipping and help you get that back to us first.
Correct.
And then you get paid for the proceeds of your sale.
Correct.
It's interesting. Costco doesn't want the upside liability when it comes to the buybacks. So they're happy to sell it to you. They're just never going to buy it back, which puts you in a bit of a position for liquidity if you need it.
Yeah, everyone's great on the buy side, but when you want to sell it back, I mean, you even see a lot of our competitors.
Exactly.
They don't want to take it back. So we do both because that's the service to our clients. Also, because we sell the products that have the highest weight and the highest purity, we don't sell thousands of products. We're going to take back the bullion, coins, and bars and sell it to another client. That's part of the reason we've been able to stay so price competitive is we sell a much smaller amount of items than a lot of our competitors.
Absolutely. Okay, let's roll in with the kind of exciting update in terms of what's happening with copper, which ties back into what I think is about to happen with silver. So the reason we need to pay attention is this is the copper price right now. The reason I've shown this chart is it kind of shows you what happens when you break out of a cup and handle. This is exactly what's happened to gold in recent months is it's broken out of that cup and handle formation to brand new all-time highs. Now, we are on the cusp of seeing copper break out of its handle right now, and we do anticipate that the next 3 to 6 months will have it forging newer higher and higher highs like gold has been making pretty much all year in 2025. So this bodes well for silver if copper's now at this kind of once in a lifetime moment where it's actually breaking out. It's in blue sky territory, and it's really going to find a much higher price over the coming months and years. So I think that this is just an interesting technical chart to see what happened when gold broke out of the cup and handle and what we can expect to happen from copper and therefore infer that may happen to silver. This next chart just has a little bit of a closer up, and this is a technical chart pattern called an inverse head and shoulder. You've got your left shoulder, you've got your head and your right shoulder. And typically when that formation breaks out, you get a very strong reaction in the price increase that happens once you're through that resistance line. So I have a little arrow there kind of indicating what I think will happen. And I think it could easily make it into the $7 a pound range in the coming months. So just more technical support for the move that we're seeing or that's happening right now in copper. And then I'm going to show this next chart, which is kind of an all-time chart for copper. It really shows you that line in the sand. We're on it right now. We've been at this level before in terms of copper being around $5 a pound, but it is going to break out now. And this is like, this is a 60-year chart or a 50-year chart. It really shows you the magnitude of the move that could be coming, where we could see the price go up by multiples in the coming years. So again, just blue sky territory dead ahead. And I think it's very, very bullish for what we can see in copper and also silver. Okay, now let's take a quick look at what some analysts are expecting in copper in terms of the trend for use and demand. So we think that the transport sector is going to rise by 11 times by 2050. And that's basically because of electric vehicles, electric vehicle fleets that are going to be coming on board. I mean, each EV has about a mile of copper wiring in it. And if you just want to do the math with how many tens of thousands of vehicles are going to be hitting the roads,
wow,
it's really a large amount. And then we think that just global electricity grid demand is going to be probably increasing somewhere in the range of 4 to 5 times by 2050 as well. And again, that's because of emerging markets. You've got India, Asia, poorer countries that are now actually turning out quite a few middle-class people, and they're going to be buying electronics. They're going to be getting more sophisticated electrical grids to power their cities. And there's a very well-known trader, commodity trader and French billionaire Pierre Andouron, who predicts that we're probably going to see in the next several years something around $40,000 per ton of copper. And right now it trades at about $10,000 per ton. So we're, again, going back to those charts, we're in kind of uncharted territory where we could see massive, massive increases in the price of copper, which again is a very bullish factor for silver. Okay, now this is a gold chart, and I'm calling it my shorter term gold chart. We talked earlier and you saw that chart. We're at new all-time highs, Colin, pretty much every week now. We've had every weekly close is the highest weekly close ever. Barring small fluctuations day to day, gold's up strongly again today. I think in the next few months, where we're probably going is somewhere in that $3,200 range over the coming, let's say, 1 or 2 months. We could probably find a little bit of resistance there, drop, and then test it again. But we are in a longer term bull market, but that doesn't happen without its ups and downs. So we're strongly through that $3,000 mark. My guess is we're getting to about 3,200 or so. We may see a brief pullback to about 2,900, just slightly below where we are now through the summer months, which tend to be a little bit quieter, barring any kind of major incidents. So, I think in the shorter term, gold still has lots of runway, get to about 3,200, and then it probably pulls back to 2,900 or 3,000, tests that previous ceiling as a floor, and then relaunches from there. This next chart, which is more of a long-term chart, this actually looks at the next 10 years or so. This kind of outlines where I think gold is going. And I want to just explain this a little bit more. So when gold enters a bull market, it generally runs for 8 to 10 years. Now, we had a good 2020, but Colin, that we pretty much consolidated around that 2000 level for 4 years, right?
Mm-hmm.
From 2020 to 2024, we just kind of were range bound between 1600 and 2000. In 2024, this time last year, we finally, and with lots of momentum, broke out of that $2,100 range, and it's just been on an absolute tear. But if we look at an 8-year-ish cycle in gold, from 2024, that puts us into about 2032. I think a lot of our clients buying at these levels know it's the most expensive it's ever been, but you really need to keep your eyes on the prize that when gold is in a secular bull market, it typically lasts 8 to 10 years, and it can and will move by multiples. And this is not a concise roadmap. You can't quote me on this per se. We don't have crystal balls, but this is just a general outline of where I think we're going. And to be somewhere in that $8,000 to $10,000 range, Colin, I don't think is out of the question.
Yeah.
I think after getting to that, we'd probably have some kind of pullback mid-cycle, and then we could probably end up shooting well north of 10,000. So I really do just try to get clients to focus on the long-term trajectory of the metals and the fact that we still have 7-8 years left in the cycle that we're currently in.
Yeah, no, I think those are some of the numbers that I'm seeing other experts come out with. And, sometimes with investing, you get really like narrow focused on what's going to happen next quarter or next month. But, sometimes you have investments that you're going to track for 7, 8, 9, 10 years. And I think, within, like, you look at some of these stocks, NVIDIA and some of these that are, expensive, near all-time highs, nobody has a problem paying those prices.
I know.
And yet with gold, there's always this conversation. So we have another one coming in here pretty soon. So I got like 2-3 minutes left. Let's
just do a quick touch on silver, and then I'm going to wrap it up there. So silver, this is a shorter term chart. We've been struggling to get over that $34 mark, which was the previous high from October. We got there briefly just a couple weeks ago, but now the dollar seems to be rolling over again. I think we have the juice to kind of in the same time frame that gold will get to about 3,200. I think we're probably going to see silver get over that 34, 35 mark and probably push upwards into 36, 37. But again, with silver, longer term view is going to be best. We're probably later this year breaking up towards that all-time high of $50. We've just got to get up 35, up above 35 or 36, hang in there for some time, and then the launch pad will be set for us to be able to challenge that 50 mark. I think that happens probably later this fall. And then this next chart, that kind of 10-year chart, same one that I gave you with gold. It's not out of the question, Colin. I know it sounds crazy for us to see $200, $300, $400 silver over the next 10 years. So on the appropriate time frame, these things happen. It happened after 08. Gold tripled in 3 years. Silver went up by 8.5 times. Mm-hmm. If we're seeing something similar happen now, gold could go from 3 to 10. Silver can go from 30 to 300. There's just no question about it. So I think that that's probably something worth keeping in mind. But this very last chart, and I'll wrap on this, is a Venn diagram that just shows you how silver ticks absolutely all of the boxes. It's the only asset that really has everything going for it in one. It's an inflationary defense. It is considered actual money in the Constitution. It's a monetary metal. It is historically cheap, especially when you compare it to how much gold's gone up by, with the gold to silver ratio still in the high 80s. It should not be this cheap. And then it's part of, like you talk about in your book, it's part of the green revolution that's going on. All the clean tech, all the EVs, all the renewables, they need so much silver to be able to fuel this stuff and get us there. And so silver is this strategic asset that kind of is at the crux of all these 4 important categories that are going to be a very important part of investment trends moving forward. And that's why I'm so bullish for it. I really can't say more about it without sounding like a sales guy, which of course I am. So.
Well, lots to digest. Obviously, people are going to want to ask you questions. Give us a call, 877-646-5347. Ask for Micah. He can go and break this down even simpler. We obviously have different guides. We have the silver book. It's a good time to learn and get it broken down to someone in a simple way. So, Micah, as always, thank you.
Thanks for having me on.
Love the charts, love the graphs, and good to have you back. And we'll see you on the next one. Anyone looking to get more information, or if you want a topic that we didn't cover for next week, send us a note. We're happy to dive into more things. But thanks for everyone for staying on, and we'll talk soon. Noble Gold Investment.